Today we're going to be talking about how you can actually use DeFi to make some money even during this bear market. Hello everyone, hope you're all doing well and welcome back to the Baking Analyst channel. On this channel we cover everything from cryptocurrencies to personal finance to economics with a focus on decentralized finance or DeFi. So if you want to learn more about DeFi, do consider subscribing to this channel, joining our Discord and checking out the free course down below that you can access with a free trial of Skillshare. With that out of the way, let's jump right into today's video. Today we're going to be talking about how currencies have collapsed and here's what you can do as a DeFi degenerate. Now, of course, the viability of this strategy depends on whether or not you are US or non-US based. For me personally, because I'm based in Europe, what this has allowed me to do is to protect the value of my savings from the collapse of the pound. So let's jump right into how we're going to go about doing this. First of all, we're going to be talking about why these world currencies have been crashing against the US dollar. We're going to have a look at some macro outlook on why this is potentially a longer term trend. And finally, we'll be looking at how crypto has to do with all of this and how you can actually use a range of DeFi strategies to profit off the fall of these currencies in a relatively lower risk way as compared to the day-to-day crypto degen. So first of all, let's have a look at why currencies have been crashing. The first issue is that of the safe haven narrative. Now, looking at the dollar index, we do see that it has reached really high levels. It has come down a bit, but it is still really high at 112. So that is really playing into the idea that the US dollar is seen as a safe haven. All the capital is just flowing towards it as we enter a period of greater uncertainty. The second reason is because of the rising interest rates by central banks and the US leading the charge, or the Fed leading the charge. And this has made US securities that are now paying a higher yield more attractive to foreign investors, causing them to dump whatever assets they had in other currencies and moving them into US treasuries, for instance. The final issue is that of the import-export dynamic. As we all know, people in Europe and in the UK, we are all importer countries. We're net importers of goods and services, whereas countries like the US tend to be more focused on domestic consumption. So if this happens, if we are more dependent on import, for instance, let's say on American gas, then we need to trade our own native fiat currencies for US dollars, causing the exchange rate of US dollars to go up. Now, moving on, we want to know whether this is likely to continue before we make any changes to our investment strategy. Now, looking ahead into the winter, we do see there is potentially the opportunity for an energy trade. Now, this is because Europe tends to be a net importer of energy, as we have all realized in the past few months. And when we're looking for alternative sources, we can look towards the US, which produces oil and gas, or the Middle East, which is also likely to accept payments in US dollars. So if we were to require additional purchases of such energy, then our currencies are going to be used to purchase US dollars first and then purchase whatever we need. And therefore, that is going to result in downward pressure on the domestic currency, or rather upward pressure in the US dollar, depending on which way you are looking at it. Finally, we have the issue of more government borrowing. I do not need to say too much about this. In the UK, the Bank of England has had to actually step in to buy up government bonds and prevent pension funds from getting margin calls. So that is really a serious issue that has shaken confidence in the market quite a bit, especially with the new budget. So this dollar strength issue could have legs to run. So now we move on to the key question that everyone came here to watch. How can I actually make money in the market, especially when everything is going sideways or downwards? So now let me share what I am actually doing. First of all, because I'm based in Europe and because the objective of this strategy for me personally is not particularly to make as much money as possible, but rather to protect the value of savings against a collapse in the pound or the euro, I'm using TradFi solutions as well. So that includes apps like Revolut, which allows a certain amount of free foreign exchange depending on which plan you buy. Some of them have unlimited free foreign exchange. If you want to check them out, I have a link down below as well. And basically, I'm just selling and keeping a part of my holdings in USD just in case something catastrophic happens. The other way, of course, is that you can actually use DeFi to boost this strategy. Now, this is, of course, slightly riskier, and this could be profitable even if you're located in the US, because what you're essentially doing is you will be shorting a foreign currency and paying relatively low interest rates on the borrowing. So let's have a look at how to execute this strategy. On a high level, the DeFi boost works like this. First of all, you can hold on to any of your favorite stablecoins, USDC, USDT, and supply them onto a lending platform like Aave. And then you can borrow out some stablecoins that are pegged to foreign currencies that you think will drop, and then go ahead and sell that back into US dollar pegged stablecoins, therefore completing the short sell. Now, when you do that in DeFi, you can now use this USDC or USDT, put it onto a yield farm and earn additional interest. And actually this interest, as we will see shortly, can be higher than the interest that you're paying to borrow this euro stablecoin, resulting in both gaining yield as well as profiting from the downward movement of foreign currencies against the USD. So let's have a look at how you can practically execute this. On the Aave, there are several choices that you can use. The first one is the arbiter market, and the other one is the Polygon market. Now, we're more interested in the Polygon market at the moment because the borrowing rates are slightly better. You can go ahead and deposit your asset on the supply side. In this case, I have, of course, deposited USDC. Then you can enable collateral and go ahead and borrow any of these euro-based stablecoins that are available. Now, of course, AG Euro is likely to be the most liquid as far as I know. Then you can go ahead and make a borrow. You can go ahead and either max out your borrow, leave some margin of safety, perhaps 10%. Go ahead and borrow that. And then, of course, you can sell that back to USDC or USDT using Uniswap on Polygon. To illustrate the point that you can get way higher than this 2.13% variable APY somewhere else, even Stargate, which is the bridge protocol, allowing you to stake your coins over here on the farm to provide liquidity for the bridge, is paying out about 4.59% on Matic on USDT, as well as 2.31%. So this is just breaking even. If you want to do more with your USDC, of course, you can go over to find some stablecoin opportunities and click on, say, Polygon in this Coindex or Nanoly page, and then you find that there are a number of options for you that include things like MyUSDC, which is paying out 5%, or you can simply bridge them out to another chain or pair them with another euro stablecoin if you want to kind of mitigate that risk of getting liquidated and earn quite a high APR. So moving on, let's have a look at some of the risks, because you might be asking, is this not risky? Well, it is risky to some extent. However, foreign exchange tends to be less volatile than crypto. Well, until recently. However, how often do you see FX or currencies pump or dump by about 10% in less than a day? Well, certainly much less often than is the case in crypto. As a result, if you were to use the aforementioned strategy and leave a margin of safety that you would usually do in a typical crypto leveraged trade using Aave, then you will be less likely to be liquidated. The second thing is that stablecoin interest spreads tend to be relatively thin. Now, of course, this could vary depending on demand for borrowing of your euro stablecoin, for instance, but for USDC and USDT, these borrow and supply interest rates tend to be within the single digits and at most the low 2 digits. It is also often the case that the interest rates for borrowing are relatively close to the interest rates that you would be able to get for supplying your stablecoins. Now, all this means that the likely loss from negative APR as a result of your borrowing interest exceeding your supply interest is considerably lower than is the case compared to if you were to do the same thing with unstable or typical volatile crypto. The final point I'd like to make is that liquidation is likely to be avoidable with monitoring. Simple daily monitoring of your portfolio and loan to value ratio on Aave is likely to largely minimize this kind of liquidation risk and therefore limit potential losses. The final risk, of course, is your personal situation. This is ultimately a speculative play, and for people who are not based in the US, of course, it could be a hedging play so that they always have, let's say, half their assets in a native currency and half their assets in USD, so they're always somehow fully collateralized. You might want to consider more closely about these risks if you're going to do just a regular short without actually holding any of the currency on the other side. So all in all, in this case, do what is suitable for your personal situation, as this is, after all, a personal finance decision. So all in all, I hope this video has been informative and useful. If you liked it, do consider leaving a like and subscribing to this channel. If you want to see more such content, we come out with this content on a regular basis, so do stay tuned for more. With that being said, thanks for watching, and I will see you in the next one.